Sivakumar joins us, head of fixed income group with Axis Mutual Fund, and then you got Upasna Bhardwaj, economist with Kotak Mahindra Bank. Good morning to both of you. Thank you for joining us. Sivakumar, long time. Good to connect with you. I think it's inevitable that the fiscal this year will get busted. I think what markets are deliberating, discussing, and wondering that will it be 0.2, 0.3, 0.4, or 0.5? What is your sense?
Yeah, I think first of all, good morning, and I think you're right. There is likely to be some kind of a fiscal slippage. I think the markets kind of absorbed the fact that there will be something significant. So even if it's a 0.5% slippage, to be honest, it's not something that the markets will be unable to digest. What is interesting, of course, is then what happens to the medium-term fiscal consolidation plan, because next year we were supposed to go to 3%. So will that get substantially altered? So I think the market is really trying to figure out this year and next year's borrowing program. Remember that next year we'll have more than 8 lakh crore of gross government borrowing, central government borrowing, given the bunched up maturities. So it's going to be very interesting to see the government's plan of action in terms of its borrowing program for next year.
All right, so looking forward to seeing what's coming up. Upasna, let me bring you in on that as well. Right now everyone's, of course, trying to figure out that balance between the fisc and growth. Geeta Gopinath talking about how it is going to be a tough challenge for the government, and the Finmin responding with how they're going to prioritize growth. What could that possibly mean, as they have a very, very narrow buffer in which to do that?
Yes, absolutely. I think, if we look at, both the sides, the monetary and the fiscal side, the monetary side is kind of exhausted at this point in time, especially because the MPC is inflation targeting, and inflation is now not at all near anywhere close to comfortable levels. So clearly the monetary policy actions have at the moment been exhausted in terms of rate cuts. Then comes the side of fiscal policy, wherein again the headroom is absolutely not there, I would say, because of the slowdown that has been witnessed in the economy. We are looking at significant tax shortfalls, and without significant expenditure cuts, clearly the targets cannot be met. So the room for the government to do incrementally more by expanding expenditure is already not there. If at all, the best case scenario is that they let the shortfall be there in terms of taxes and not cut expenditure, and hence deliver the fiscal deficit level whatever comes by, which means a slippage easily up to 50 basis, which they can exhaust by invoking the FRBM clause, escape clause that they have. So that is the best case that they can do. At least by not contracting expenditure, they would at least try and not pull back growth, whatever little support that the economy is getting from the government side. Because at this point in time, of course, there are issues. The private sector side, we're not really looking at meaningful, capex expansion. Capacity utilization still remain pretty much, on the lower side. Demand is missing. Yes, I would like to just highlight one thing, that from November onwards, we are seeing some very early signs of stability. Slower amount of contraction across various sectors that we were seeing. So that doesn't necessarily mean that the economy is doing well, but it is not probably decelerating at the same pace as it was until October. Until October, the data was extremely bad, and it was worsening by the month. But now in at least November, whatever few numbers that we have, it's showing some signs of bottoming out, so to say. But having said that, that still doesn't provide much comfort when it comes to looking at the next a couple of months. And overall, the growth is expected to remain muted. So we are looking at 4.7% for the full of this year growth, real growth, and nominal growth also will be meaningfully lower, which is important from a budgeting perspective. So 7.7% is the nominal growth that we're looking at for this year, as against a near 11% growth which was budgeted in the fiscal numbers. So I think it becomes very difficult at this point for the government to manage the maths behind the fiscal numbers. It is better to let go of some of it without pulling the strings through expenditure cuts.
Yes, indeed. So, painting a fairly bleak scenario. And Sivakumar, I'd like to get in your take. At a time when we're looking at that spike in food inflation, we're looking at the overall sluggishness in GDP growth, as well as the the overall slowdown that we've been flagging off. Do you think at a time like this, given the fact that the RBI measures may not have had too much of an impact, that now government intervention is the next call of the hour?
Government intervention in some respects, yes, but government intervention through expansionary policy, not necessarily. Expansionary fiscal policy, not necessary. I would like to disagree that monetary policy has run out of room. Monetary policy you have delivered rate cuts and you have delivered liquidity, but you have actually not budged the lending rate by banks. If you look at the weighted average lending rates by the banking system, it's practically unchanged through the course of this 135 basis points of rate cuts and this extraordinary liquidity stimulus or this QE that we have seen. So what is happening is there's a broken transmission mechanism, which I would say that requires some intervention from the government in terms of getting the PSU banks to start lending, but also we need the RBI to start looking at transmission more seriously, in having conversation with banks to figure out where are the pain points to get that moving. Because the government, at the end of the day, the government consumption expenditure is 10% of GDP. You need to move the 90% of GDP, which is private sector, if you need to have any kind of acceleration back in the economy. So when we are talking about fiscal measures, it's really at the margin. We really need action. More action on the monetary side, on the banking side, for a genuine recovery to come through. Now, in our view, you have more than 2 lakh crores, close to 3 lakh crores of excess liquidity, which is being parked with RBI at 5%, when the banks could be lending this to the private sector at 10%. So why are banks giving up on this 5 percentage point spread? Ask another way, how long can they sustain passing up this 5 percentage point spread? I believe that over the next few months and quarters, you will start seeing this money move into the real economy. So we should start seeing the economy stabilize and improve when you take a, let's say, 6 to 12 month forward view. So we're not really bearish on the economy, and I think the government should do limited steps, allow the fiscal deficit to expand for sure, but not go overboard.
To play devil's advocate here, I mean, I know Sivakumar is sounding a little bit more optimistic. We've got the heightened CPI, contracting IIP, widening trade deficit, slowing growth, possible deflationary scenario. We're not there yet. Given that demand hasn't come back, it could be a downward spiral. I mean, I know you just said things seem to have stabilized, but we're not really seeing constructive growth either. How do you expect 2020 to shape up? That was for you, Upasna, yeah.
Yeah, so like I said, growth going ahead, we are expecting that since we are kind of close to the bottoming out of the slowing cycle, we're expecting a minor recovery next year, of course. But again, we don't expect incrementally too many factors to be contributing as much yet next year. There's a lot of saturation across various sectors, and we would be looking at what kind of developments that really happen across various sectors to really incrementally bring the economy back to a 7% plus growth. In fact, at this point, our next year's projections are looking at closer to 5.5%. So not a very meaningful improvement, but yes, a marginal improvement, which would be led by, I agree, that there will be a pass-through of transmission, and as a result of which maybe some kind of a partial revival in demand which would come about. But at this point in time, I think there's a problem of both supply and demand. There is a reluctance to lend yet. That easy availability of credit across, of course, it's differential across various sectors, but it's still there. Maybe next few months down the line, we would see that get resolved. And once that supply and demand issues start slowly, converging, we would start seeing some kind of a revival. So we are a little more hopeful in the second half of next year, but at least next 6 months, 9 months, we're still looking at relatively tepid recovery.
All right. Thank you both for joining us and talking us through, how you're seeing the economy in 2020. Still sounding optimistic that we have bottomed out despite some of the commentary coming in otherwise.